I wouldn't say it's faltering. I think we went into the beginning of this year with very high expectations, or the market did, notably having this very sharp, what we call a V-shaped recovery. But I think we've got to look at this recovery versus previous recoveries we've seen in China. So whether it's 03, 2009, 2016, and this recovery is different because the Chinese authorities really aren't throwing the same kind of stimulus into the recovery that we're used to see.
When China relaxed the zero COVID restrictions, the hope was that would allow the economy to bounce back pretty quickly. And we did see a decent recovery in the first quarter. I think the challenge is that there are a lot of other factors, not just purely related to the pandemic, but the downturn in the property sector, the wider problems with local government debt. And these are all sort of structural headwinds that are still weighing on the Chinese economy. I don't think they're going to be enough. I mean, look, you're talking about 10 basis point reductions, which are pretty tiny in the grand scheme of things. And even if they were to go a bit larger than that, do a few more rate cuts, cut reserve requirement ratios, and even increase some of the loan quotas that they hand out to the banks, the fundamental problem for monetary policy in China at the moment is that the constraints are not in terms of the quantity of credit, but just the demand for credit. And with sentiment as weak as it is, there's no guarantee that firms and households are going to start to borrow a lot more just because you've lowered borrowing costs by 10 basis points or a little bit more than that.
We can't see the central bank in China, so the PBOC, cut too much because we're seeing most other central banks around the world, in fact, tighten interest rates. So the interest rate differential would indeed widen. And also China's problems don't relate to people not having enough money for their mortgages like you see in other economies. The issue about China is the confidence of the household. So there's about 37% of household savings. And it's about encouraging those savings to be deployed through consumption. And I guess, again, we're probably going to see these tweaks to policy, both monetary and fiscal, just to really spur on this confidence. Yes, and again, if we look at these past recoveries, it was really the property cycle that tended, along with commodities, to really underpin the recovery. But China doesn't need all the properties that it used to need. In fact, there's an overabundance of property supply. And so what's happened in the property sector is that you've seen the state-owned enterprises really take a lot of market share. So land sales now really skewed in the SOE's favors. And historically, the private developers would be very aggressive with their projects or their startups, using the funding from the pre-sales, and state-owned enterprises don't behave in that same manner. So again, we need to reset expectations about the type of recovery that we're seeing this time around.
The property sector is such an important driver of China's economy, drives around 20% of overall growth. And so if the property sector is not doing well, it's very difficult for the rest of the economy to return to the growth rates that we saw prior to the pandemic. And essentially the problem at the moment is that households are not at all confident, first of all, in the ability of developers to actually finish projects and deliver them. And also there's a general lack of confidence in the prospects for housing as an asset class in China. I mean, historically, it's been considered one of the safest asset classes, which has delivered the strongest returns. But there's question marks over that given the demographic headwinds. At the margins, yes, although I think the risk is we could well see, in response to the weakness in the service sector, that we get greater fiscal stimulus, and that boosts construction activity and then pushes up commodity prices. And actually, of course, the construction sector in China is far more import intensive than the service sector. So actually, the risk here is that although China is doing worse, maybe there's a bit of weakness in goods demand, and that allows goods supply to improve globally. As you know, commodity prices tend to be a lot more volatile, and the risk is that stimulus could actually boost those prices.
It's probably seen its worst. And again, we're only about in 5-6 months worth of data. So the government's probably going to continue to look at the data set in terms of focusing where they should address policy. And the area that potentially we do need to focus on is both the credit numbers. So how much corporates, households are potentially borrowing, that's going to be a sign of confidence, as well as the employment market. And this goes for all economies in terms of the health of the labor market. But again, I do want to highlight that the importance about China is that households are cash cash rich. It's just a matter of getting people to spend to spur on both corporate as well as capex, as well as households themselves.
The construction sector is a lot more import intensive. So if they have to turn to construction to support growth, then actually, ironically, the bad news in China for China's domestic recovery could be good news for Australia if it increases Chinese demand for things like iron ore. So there could be a bit of a silver lining in this for Australia.
So again, from a Chinese perspective, if we look at the equities market itself, there's so much negative news priced into the Chinese market. So multiples are very, very attractive across all sectors. It's almost a problem of plenty when you look for investment opportunities. What does this mean for Australia? Well, Australian corporates, so the exporters, especially the commodity players, again, need to be mindful of the new direction or the new growth model that China's undertaken. So less aggressiveness in terms of property and infrastructure spending, maybe more of a focus on domestic demand, and indeed what kind of Australian products or services could tap into that huge consumption story, which we do believe is still very much intact.